All right, I've got some notes here because there's a lot of language that I'm not going to be able to read. And these are just some ideas and thoughts from Carson's investment committee. And there's a dog right there, so this will be fun to write on the whiteboard. I will probably trip, and that'll make for a great video. Overall thoughts from Carson's team. So we'll fly through this, and if it gets too technical, I'll take some pauses to explain it in layman's terms. With the passage of OBBBA, the economy has some added cushion against stocks. Slowing job growth and inflationary pressure are concerns, but corporate America has remained resilient. What does that mean? There's pressures, there's concerns. That's always going to be the case. But corporate America, the stock market, has weathered the storm. This is a big one for me. AI investment has been providing and adding macroeconomic tailwind, but the potential for AI disruption is contributing to some market uncertainty. What that means to me is productivity. We have periods over the course of history, and I've talked about this in prior episodes, where we have this massive shift in productivity. The internet, email, things like that, fax machines even. Now we have AI, that increases productivity. Productivity is a great thing for how the stock market performs. Now, of course, we can get into, is AI a good thing or a bad thing? I'm not going to get into that today, but is it good for productivity, which is good for the market? Yes, it is. Overall, US versus international has kind of balanced out. So a few years ago, we liked US over international. Last year is more international over US, which proved to be a good bet. And now it's a little more balanced out in terms of fixed income, which is bonds, underweight credit, bonds, overweight treasuries, and TIPS, Treasury Inflation Protected Securities. So a little more government bonds, a little less on the corporate bond side. And then overall, this has kind of been a trend for a while, diversifying diversifiers, gold, managed futures, diversified real assets, things that are tangible that we can touch, feel, see. Okay, what does that mean overall? So we are overweight equities. We are specifically overweight large cap equities and underweight mid and small cap companies. Overweight the bigger companies, underweight the smaller companies. As terms of sector preferences, we like technology. That's what Ryan was talking about, and a little bit that I was paying attention last week when he was on CNBC. Technology, communication services, and utilities. Utilities are known as being a stable part of a portfolio. Okay, last thing I'm going to talk about here, because it's the most exciting. So if you're still with me, which I understand, I probably lost a lot of you during this episode, but that's okay. I'm going to do this anyway for those of you who are interested in all this information. Stock portfolios. Growth leaders, dividend leaders. I think I have another one on here, market leaders, but I'm just going to talk about some of the stocks they bought and sold and why. So within growth leaders, completely exited the position in INTU, which is Intuitive Surgical Robot Surgery, decreased Google, and established a position in Lam Research, LRCX. So a couple others, I do have a little more detailed information on why we bought or sold. We exited Oracle and established a position in IBM. We exited Oracle because the relative ranking fell outside multi-factor ranking model. Again, just looking at different factors, trends, growth, momentum, volatility, share price. Is it expensive or is it on sale? And if it doesn't meet certain criteria, we're going to dump it. Established a position in IBM. Basically, that one was because it was good value and it's a lower volatility position. And then last thing on the stock side, exited Tegna, which is a TGNA is the ticker there. That's a media company. We exited them because they were purchased by Nextar Media. Sometimes a purchase and a merger can be good, sometimes bad. In this instance, bad, so we dumped that. And with that, established a position in PLXS, which is Plexus, an electronics organization. And then lastly, just kind of want to talk about some trends that we're following. We had a big position, I should say, a strong relative strength rating for commodities, January, February, March. Reason being, when we look at all these different factors, there was in March, first several days in March, we added 70 relative strength signals to commodities. We saw that. So commodities actually became the #1 position in our trend portfolio. But that quickly reversed. They lost 56 strength signals in April. So while they were '1 January, February, March, they actually dropped, and they are now back in the 3rd position. And let's see who went to #1. I believe it was international. International. So we have international in this particular portfolio, #1, US equities #2, and then commodities #3. So a quick flip-flop there of US equities and commodities. So there you have it, just a little bit of insight, kind of a long video there, but you know, if you're interested in this stuff, maybe that was a fun video, but also a good chance, I mean, the dog is bored, so I guess it's time to move on. Here we go. Bye.